John thought he understood investing, but after watching endless videos online, he realized everyone had a different opinion about what actually builds wealth. Some people said dividend investing was the safest way to create passive income for life. Others claimed growth investing was the only real path to becoming rich. After hearing both sides over and over again, John decided to stop listening to opinions and test it himself with real numbers. So one morning, he opened his Fidelity account and asked a simple question. What would happen if he took just $10,000 and invested it into the three best Fidelity index funds for income, growth, and international exposure? What he discovered completely changed the way he looked at money forever. John didn't want random stocks. He wanted a portfolio built on strong foundations. So he started searching through Fidelity's entire list of index funds, looking for three specific jobs to be covered. First, he needed a fund that could generate reliable income through dividends. Second, he needed a fund focused on aggressive long-term growth. Third, he needed international diversification, so the entire portfolio wouldn't depend only on the United States economy. After days of comparing performance, dividend growth, fees, and long-term returns, he finally narrowed it down to three Fidelity funds that handled those jobs better than almost anything else on the platform. The first fund John picked was FDVV, the Fidelity High Dividend ETF. This became the income engine of his portfolio. FDVV focuses on large U.S. companies that consistently pay dividends and are expected to continue increasing those payouts over time. What shocked John most was the type of companies inside the fund. He expected old utility companies and slow-moving energy businesses, but instead he found names like Apple, Microsoft, Nvidia, and Visa. These weren't dying companies desperately paying investors to stay interested. These were some of the most profitable businesses on earth, generating so much cash that they could continue growing while still paying billions back to shareholders every year. At first, John didn't fully understand why dividends mattered so much to long-term investors. Then he learned something important. A dividend is simply a portion of a company's profits paid back to shareholders, usually every few months. The more shares you own, the more money you receive. And if you reinvest those dividends instead of spending them, the process becomes extremely powerful. The dividends buy more shares. Those shares create more dividends. And over time, the snowball keeps getting larger. That's when John realized dividend investing wasn't about getting rich overnight. It was about building a machine that slowly pays you more and more money every single year. Once income was covered, John moved to the growth side of the portfolio. For that, he chose FNCMX, the Fidelity Nasdaq Composite Index Fund. This became the aggressive growth engine of the account. FNCMX tracks thousands of companies listed on the Nasdaq exchange, which means the portfolio naturally becomes heavily weighted toward technology and innovation. The top holdings included Apple, Nvidia, Amazon, Meta, Tesla, and Microsoft. These companies weren't designed to pay huge dividends. Instead, they reinvest most of their profits back into expanding their businesses, dominating industries, and pushing stock prices higher over time. John quickly realized the biggest difference between growth investing and dividend investing. Dividend investing focuses on creating cash flow today, while growth investing focuses on creating the largest possible account value later. FNCMX barely produced much income compared to FDVV, but historically, it delivered significantly stronger price appreciation over long periods of time. That higher growth rate compounds into enormous wealth. John understood that, if he wanted the biggest account possible decades later, growth funds would likely do most of the heavy lifting. Now John had income and growth covered, but there was still a problem. Everything he owned depended entirely on the United States economy. If America ever struggled for a long period, his entire portfolio could suffer badly. That's when he added the third fund, FDIHX, the Fidelity Total International Index Fund. This fund gave him exposure to thousands of companies outside the United States. including businesses from Japan, Germany, India, Taiwan, Brazil, and many other countries around the world. At first, John almost skipped international investing completely because US stocks had outperformed international markets for years. He kept asking himself why he should buy something weaker when American stocks seemed unstoppable. But eventually he understood something most investors forget: markets move in cycles, and no country dominates forever. International diversification wasn't about chasing the hottest returns right now. It was about protecting the portfolio from becoming too dependent on a single economy for the next 30 years. What surprised John most about FDIHX was its dividend growth potential. Even though international stocks had lagged behind US stocks overall, the dividend growth rate inside the fund was extremely strong. That meant FDIHX wasn't just diversification, it was also a long-term income compounding engine. Suddenly, John realized his portfolio had all three major pieces working together. FDVV generated income, FNCMX generated growth, and FDIHX provided global diversification while also helping future dividend growth. But then John realized something even more important. Picking the funds wasn't actually the real strategy. The weightings were. The exact same three funds could create completely different outcomes depending on how much money he allocated to each one. One portfolio could prioritize income and monthly cash flow, while another could prioritize maximum long-term growth. Same funds, same starting money, totally different future. So John built his first version, the dividend-focused portfolio. In this version, 50% of the money went into FDIHX, 30% went into FDVV, and only 20% went into FNCMX. At first glance, the allocation looked strange because the international fund became the biggest position, but John understood why. FDIHX had an extremely strong dividend growth rate, meaning over decades it could dramatically increase the portfolio's future income stream. FDVV provided immediate dividend income, while FNCMX stayed smaller because this portfolio wasn't trying to maximize account size, it was trying to maximize future monthly income. When John projected the portfolio forward over 30 years with dividends continuously reinvested, the results shocked him. The account started slowly during the first few years, but eventually the compounding became explosive. By year 30, the portfolio was projected to grow into more than $400,000, despite starting with only $10,000. But the account value wasn't even the most impressive part. The dividend income eventually grew large enough to potentially pay over $2,000 every single month without selling shares. That completely changed how John looked at investing. Suddenly the portfolio felt less like numbers on a screen and more like ownership of real businesses paying him consistently whether the market was going up or down. He also realized a huge percentage of the portfolio's growth came directly from dividend reinvestment itself. Every dividend payment bought more shares, and those shares generated even more dividends later. Over decades, that cycle became incredibly powerful. But John still wondered something important. What if income didn't matter yet? What if the goal was simply building the largest account possible? So he rebuilt the exact same portfolio in a completely different way. This became the growth-focused version. Now, 70% of the money went into FNCMX, 20% stayed in FDVV, and only 10% remained in FDIHX. The strategy completely shifted toward aggressive long-term appreciation. The moment John projected this new portfolio forward, the difference became obvious. During the early years, both portfolios looked somewhat similar, but over time, the growth-focused portfolio started pulling far ahead. By year 30, the account was projected to approach nearly $700,000. John couldn't believe it. Same $10,000, same 3 Fidelity funds, yet simply changing the weightings created a difference of hundreds of thousands of dollars. However, there was a major trade-off. Even though the growth portfolio became dramatically larger, the monthly dividend income stayed very small compared to the dividend-focused version. Most of the wealth existed inside rising share prices instead of cash payments. That meant if John wanted to live on the portfolio later, he would eventually need to start selling shares to generate income. And that introduced a completely different type of risk. If the market crashed right after retirement, John could be forced to sell investments at lower prices just to pay his bills. That's one reason many retirees prefer dividend-focused portfolios. Even when the account value ends up smaller, the income continues arriving without needing to liquidate assets during bad markets. At the same time, John also understood why growth investors love larger portfolios. A massive account balance creates flexibility. Even small withdrawals from a very large portfolio can still produce substantial retirement income later. Neither strategy was automatically right or wrong. They simply solved different problems. That's when John finally understood the biggest lesson of all. Successful investing isn't just about picking great funds. It's about building a portfolio that matches the life you actually want to live. Some investors want maximum monthly income. Others want maximum long-term wealth. Some prioritize safety and stability, while others prioritize aggressive growth. The portfolio should reflect the goal. By the end of the experiment, John stopped asking which strategy was universally better. Instead, he started asking a much smarter question. What kind of future do I want my money to build for me over the next 30 years?